Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Phillip Securities Research. Today, we will be discussing on the recent surprise move by China's central bank, its rationale, the impacts and risks. Recent data showed the economy losing more steam in the fourth quarter and consumer price inflation falling. Full-year growth for this year is expected to hit a 24-year low at around 7.4%, undershooting the government's 7.5% target, and could go even lower as Beijing accelerates on their ambitious structural reforms. Even as China's economy showed signs of weakness, policymakers have refrained from broad stimulus measures like rate cuts to support growth, fearing it could fuel debt and property bubbles and dent their reformist credentials. Instead, for months, they have persisted for modest stimulus measures, including making new credit lines available to certain banks and financial institutions. In particular, cuts in reserve ratios for selected banks and liquidity injections into the banking system. They also focus on specific goals like supporting the agricultural industry and constructing subsidized housing. But these unconventional measures appear to have had limited effect. Increasing liquidity has failed to lower borrowing costs for the real economy, especially for the corporate sector. Borrowing costs remain high, and growth in new lending remains lackluster. Against this background, the People's Bank of China, PBOC, cut its benchmark one-year deposit rate by 25 basis points to 2.75% and reduced the one-year lending rate by 40 basis points to 5.6%, which took effect since last Saturday, November 22nd. Policymakers also said they would give China's banks more leeway in determining interest on deposits, a further step in the nation's liberalization of interest rates. For one-year deposits, banks may now pay depositors as much as 120% of the benchmark rate, up from 110% previously. It also scrapped limits on interest rates for long-term deposits of 5 years and simplified its system of benchmark rates for loans. The surprise rate cuts, the first in more than 2 years since July 2012, reflects a discomfort among the country's leaders with the speed of China's economic deceleration. It suggests that the overall policy orientation has shifted to be more supportive. That is, a change of course to a bold monetary policy step to stabilize the world's second largest economy. China joins the parade of global policymakers who are stepping up their stimulus efforts to support growth, cutting rates and filling a void left by the US Federal Reserve, which just ended a 6-year bond buying campaign that has kept borrowing costs low, as well as has encouraged spending worldwide. China's rate move comes after the Bank of Japan's surprise on October 31st by dramatically increasing the pace of its money creation, while European Central Bank, the ECB, signaled it is ready to act quickly to deter deflation. Japan's central bank abruptly decided to ramp up its bond buying campaign last month as the government's revival plan faltered, as Japan's economy plunged into a recession in the third quarter. On the other hand, Europe's economy stagnates and inflation remains dangerously low, despite interest rates were cut to all-time lows and a series of asset purchases programs were introduced to pump liquidity into the financial system. The region's central bank is considering a large-scale government bonds purchase, a policy known as quantitative easing. ECB President Mario Draghi signaled that the ECB will use all means available to us within our mandate to return inflation towards our objective and without undue delay. As such, global liquidity remains abundant and will continue to be so in 2015, given the collective action to support growth and to ward off deflation. Having said that, the Chinese central bank is keen to show that it was not backtracking on economic reforms. It tempered expectations for more aggressive stimulus, emphasizing that the prudent monetary policy would not change direction in a fundamental way. The rate cut soothed the global markets. Shares and other growth-sensitive commodities all leaped on the news. It could prop up the flagging economy, particularly in investment, amid China's effort to rebalance the economy. The action will lift the country's flagging housing market and large state-owned companies, as well as bolster other nations that have come to rely on those core parts of China's economy. And the main effect will be to improve the financial position of large firms. The rate cuts reduce financing pressures for bank borrowers. Typically, those are larger companies and state-owned companies, the SOEs, which tend to enjoy easier access to loans from the government-controlled banking sector. That will help ease China's debt pressures as companies find it cheaper to pay off refinanced loans that are coming due. In fact, by simply reducing the debt burden on companies will ease the pressure on many, which could help avert one of the biggest potential risks to the economy, that of bad loans leading to a debt crisis. It also gives confidence to investors in next year's growth outlook. Shares are likely to rally, coming from confidence that growth is not going to collapse. It will also spur stronger loan growth, hence benefiting the banks. Nevertheless, the asymmetrical cut in interest rates, that is, the fall in the lending rate is more than that in the deposit rate, will shave banks' net interest margins. But the move is not without risk. While cheap credit helped fuel an aggressive expansion after the global financial crisis, it also led to ballooning levels of corporate and local government debt. The rate cuts and any new lending they spur may raise further alarms that the debt levels are unsustainable. A wave of bad loans could set the stage for a severe economic downturn or another financial shock. With a cap on what banks can pay customers on their deposits raised, leaving savers with unchanged returns at banks that raise rates to the new ceiling may help banks to retain deposits amid competitions from shadow banks and the so-called wealth management products, while protecting savers' returns. Thus, cutting rates while liberalizing rates at the same time may be able to minimize the damage caused by the stimulus somewhat. Last but not least, we maintain our overweight bias on China, but remain cautious on how the stimulus measures will play out. To capture the long-term growth opportunities in the region, you may consider to invest into the following unit trusts or ETFs. With that, I have come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Securities Research. Tune in for more Markets Watch videos.